Today I'm going to show you how you can buy stocks at a discount. Welcome back to my channel where we are going to be financially smart together. Now, before we get into the strategy, please remember to subscribe and hit the notification bell so you won't miss out on future lessons like this. And as always, if you have any questions throughout this video, put them in the comment section below. In order to generate income while waiting for your stock to fall to the ideal buy price, you'll need to sell a cash-secured put option. This is where you sell a put option and have the money to buy 100 shares of the underlying stock at the option strike price, which as a put seller is your obligation as long as it's on or before the expiration date. Also, you want the put option that you sold to expire worthless so that you get to keep all the premium you collected and repeat the process. So let's see how cash secured put works. We're going to use Microsoft for this example. However, this is just an example picked at random, not a suggestion for you to buy Microsoft stocks or options. Right now, Microsoft is at $231.60 and at a correction. So let's just say that I want to own Microsoft at $225. So I'm going to sell the April 1st, 2021 put option with a strike price of $225, and the bid price shown is $4.25. So I would receive a total premium of $425 because again, the bid price is quoted per share and one contract is 100 shares. To calculate the return for selling this option, it's a premium of $4.25 divided by the strike price of $225, which gives you 1.89%. If you repeat this process 12 times for the whole year, then you'll have a yearly return of around 22.67%. Another way to look at this is instead of looking at the premium as income, you can think of it as a way to decrease your cost basis of owning the stock. So each time you sell an option like this, you can decrease the cost basis of owning the stock by the premium amount. I personally sell out of the money or at the money cash secured puts depending on where the stock fell to already and how much I want to own 100 shares of that stock. It's best to sell when implied volatility is high because that will result in higher option premiums. And I personally sell cash secured put options that expires around 30 days and it doesn't have to be exact. Sell the put option on a great company that you plan to own 100 shares of for the long run. So technically, there isn't much risk to sell cash secured puts because you would have bought 100 shares of the stock from the marketplace anyways. And this strategy simply reduces your cost basis for owning that stock. And sell the put option at a strike price that you don't mind owning the stock at. In other words, I would sell it when the stock is retracing back to its moving averages, not when it's surging up and overbought. Because remember, stocks usually move in wave patterns. Two things can happen by the expiration date when you sell a cash secured put. The stock can trade above the strike price of the put option. Also remember in the Microsoft example, I sold an out of the money put option, so the stock price will trade above the strike price when the stock moves up, moves sideways, or falls just a little bit. And this is where your option expires worthless and you get to keep all the premium you collected. And when this happens, you can just sell to open another cash secured put option at a further expiration date. The second scenario is when the stock trades at or below the strike price, in which case you have a few options. You can be assigned 100 shares of the stock that you wanted to own anyways, and then start selling call options on that stock position. Or you can roll your option by buying back the put option that is about to expire and then selling a further dated put option either at a lower strike price or at the same strike price. Now, I just want to point out here that there's a break-even point, which when you sell a put option is the strike price minus premium. So if the stock is above this break-even point, you would see an unrealized profit, which you can then just buy to close your put option position for a profit. It's best not to sell a put option without having enough cash to cover the assignment. And the best way to avoid accidentally doing this is to wait until the Monday after your put option expires before selling to open another put option. Or by buying back to close your put option position and then selling to open a new put option position with a further expiration date, all in the same transaction. Now that you know how to get stocks at a discount, check out the video where I show you how to generate monthly or even weekly income on your stock holding, as well as a video where I show you a strategy putting these two concepts together.